The first exercise that we'll go over is, again, is dealing with the petty cash accounting. It's going to tell you the number, but the number probably is different than what it would be in your book. So let me click on that. Okay, this company, Wupaka, I guess it is, company establishes a $350 petty cash fund on September the 9th. On September the 30th, the fund shows $104 of cash along with receipts for the following expenditures. So remember, when you pay out cash, that you will pay out the cash for whatever it is, and then you'll have to write a receipt. The person receiving the cash will sign the receipt. So you keep they get a copy of the receipt, and then and the cash, and you keep a copy of the receipt in the box with the cash. So transportation in of 40, postage expense of 123, and then miscellaneous expenses of 80. Now the petty cashier could not account for a $3 shortage in the fund. So somehow in that there's a discrepancy. Okay. And this company uses the perpetual system in accounting for merchandise inventory. And so we will prepare the journal entry to establish the cash fund on September the 9th. And so what we would do is we would debit petty cash in the amount of $350 because we're increasing our petty cash, and petty cash is an asset. And then we will credit cash $350 because we want to reduce the amount of cash that we have now by $350. So that establishes this right here. This establishes the petty cash fund. And then we'll go ahead now and do our journal entries in order to reimburse the fund. Okay. So we know then that we will credit cash in the amount of $246, and that reimburses the expenses that we took out as well as the cash shortage that we had of $3. And then we just go ahead and we debit merchandise inventory for 40 because that was the transportation in for merchandise inventory. We'll debit our postage expense 123, our miscellaneous expense 80, and then our cash short and over, we will debit that for $3 because we're short $3. So all of this here would equal this. And then that 243, that will bring us back to having, along with the cash that we have already in the petty cash fund, that will bring us back to what should be in there. And then we realized that we actually wanted to have a little bit more in the petty cash fund. We realized that 350 isn't enough, so we need to increase that. And so in order to increase, so that first one sets up the petty cash fund. This one here reimburses the fund. I'll just say reimburse. And in this one right here, we're going to add or increase. So we'll increase it. So we know that to go from 350 to 400, that's a $50 increase. So on October the 1st, we will debit petty cash 50 because we're increasing, and then we'll credit cash 50. All right. So that's that one. So Pomona Company establishes a $200 petty cash fund on January the 1st. On January the 8th, the fund shows $38 in cash along with receipts for the following expenditures. So postage of $74, transportation in of $29, delivery expenses of $16, and merchandise expense, miscellaneous of $43. And they use a perpetual system for accounting. So then we'll go ahead again, the transaction order to establish it. again, would be a debit to petty cash in the amount of 200 because we're increasing petty cash asset, and then we will credit cash 200 because we are reducing our cash. And then to prepare the journal entries to reimburse it is we had 162 in expenses for the period of time, and we want to go ahead and reimburse that. And then so you just list, so postage expense 74 debit, merchandise inventory 29, and that is for the transportation in, delivery expense of 16, and then miscellaneous expenses of 43. You add all of these up, then the credit would be 162 in cash because we're going to write a check. We'll have it cashed, and then we'll put that cash along with what is left, and that'll be our petty cash fund. So that brings it back to 200. Then we realized that 200, that wasn't enough, and we want to increase it to 450. So in order to increase it, then will be a debit to petty cash in the amount of 250 because that's the amount of the increase. We started out at 200. We want it to be 450. So we'll add 250 to it. So debit to petty cash and then credit cash for 250. Doing a bank reconciliation. All right, Delgado Clinic's cash account or their bank account shows a debit balance of $11,589, but its bank statement shows $10,555 on deposit at the close of business on June the 30th. The outstanding checks as of June the 30th total 1,829. So what that means is that Delgado Clinic wrote checks out in total in the amount of 1,829 that have not been presented to the bank and paid yet by the bank, at least not at the time that the statement was produced. So, and then we see here that June the 30th bank statement included a debit memorandum of $16, for bank services. So there was a deduction made to the bank balance because of bank services. And then there was a check number 919 that was listed with the canceled checks. It was correctly drawn for $467 in payment of the utility bill. But we noticed that Delgado Clinic mistakenly recorded it as a debit to utilities expense and a credit to cash in the amount of $476. So they had, the check was written for the right amount, but when they went to record it, they recorded it for an incorrect amount. They just got the two numbers there transposed. And then on June the 30th, cash receipts of $2,856 were placed in the bank's night depository, and it was done after the bank had closed, and it wasn't recorded on the June 30th statement. It was picked up and processed that following day, so it isn't on the statement. And so we'll prepare the bank reconciliation using the information above that we discussed. So we have the bank balance that's showing on the statement of $10,555. Our book balance is $11,589. So that's how much, according to our accounting records, that we should have in there is $11,589. So we have to make both of these agree. Okay. So we have, first of all, we have to deduct our outstanding checks, and that's the amount of 1,829. So again, checks written that haven't been processed yet, we'll deduct that from the bank balance because the bank doesn't know that those checks are outstanding. And then we'll have to deduct from our book balance the bank service charge of 16 because the bank took it out, but we haven't yet taken it out of our books yet. And then we have to add back the amount of the error of $9 that we made on the check number 919. And of course, we'll have to go back in and fix that in our journal entry. Okay. And then we have to add back also the deposit for June the 30th that we dropped in the night depository box, but has not been posted yet, of $2,856. And so if we add that to the bank statement balance, we get $13,411. And then if we subtract the 1,829 from 13,411, we now have an adjusted bank balance now of 11,582. And if we come over here, we add $9 to our book balance, we get 11,598. And then we have to subtract our bank service charge of 16. So then our adjusted book balance then is 11,582. And then you noticed, let me go back. Oh, pardon. Well, here, I'll just show you here. It's this one. You notice then that both of these balance the adjusting entries now. So we have already went ahead, we prepared our bank reconciliation. Well, now we have to go ahead and do our adjusting entries. So the first thing is on June the 30th then, is we have to correct the check that we recorded the wrong amount. The check was written out for the correct amount, but in our books, we wrote the wrong amount. So the discrepancy there is $9. So we wrote down initially that it should have been $476, but the check was really for $467, so $9. So we'll debit cash because we need to increase cash by the $9. And then we need to credit our utilities expense by $9 because we overstated that by $9, our utilities expense. Initially, we debited utilities expense, credited cash. Well, in this case, we're just going to do the opposite because we want to correct that. And then we had a miscellaneous expense of 16. We want to debit that because that was for our bank service charge. So we need to record that. And then we will credit cash for 16 in order to decrease the amount of cash. Okay, Wright Company's cash account shows a $27,500 debit balance, and its bank statement shows $25,800 on deposit at the close of business on May the 31st. So we're going to prepare a bank reconciliation for the company using the following information. So on May the 31st, bank statement lists $100 in bank service charges, and the company has not yet recorded the cost of those services. Outstanding checks as of May the 31st were $5,600. So again, the Wright Company wrote checks that have not yet cleared the bank yet for that amount. And then C, May the 31st, cash receipts of $6,200. They were placed in the bank's night depository after banking hours, and so they weren't recorded on the May 31st bank statement. In reviewing the bank statement, a $400 check written by the Smith Company was mistakenly drawn against Wright's account. So there was a check that came out that was not the Wright Company's check, okay? It was someone else's check that got taken out on their account. And then the bank statement shows a $600 NSF check from a customer, and the company has not yet recorded this NSF check. So the company had deposited a check and thought that the money was there for that check, but it came back dishonored. Okay, so we have to reduce that. So first of all, let's do the bank reconciliation. And actually on this one, that's all we're going to do. We're not going to record the entries. So again, we have our bank balance, we have our book balance. Okay. So our book balance shows that we should have $27,500 in our bank account, but on the bank side, they only show $25,800. So then first thing we need to do is we'll deduct our bank service charge of 100 because we haven't considered that yet in our book balance. And then we'll deduct our outstanding checks of 5,600 from our bank statement balance. And then for our bank statement balance, we'll go ahead and add the deposit that we made, but they haven't posted it yet, of 6,200. And then we'll go ahead and add back the bank error of 400 because that was taken out of our account and shouldn't have been. And then for our bank balance, we will take our NSF check and we'll deduct that, our return check, okay? So then what we'll do is we'll go ahead and add up the things that we're adding and then the things that we're deducting. And we come out with that the adjusted bank balance should be 26,800. And then we're not adding anything over here to the book balance, but we're going to have to subtract 700 from it. So then we get that the adjusted book balance is 26,800. And so we see that both balance that way. Figuring out liquid assets and accounts receivable. So Bargain's company reported the following year-end information. So they had net sales and in their accounts receivable. So we're going to use the information to calculate the days sales uncollected at the end of year one. And so to figure that out, you're going to take the accounts receivable, divide that by the net sales, and then multiply by 365. So I'll do this one for you. So come over here. So the accounts receivable for year one was 65,000, and then we'll divide that by the net sales, which is 730,000, and then we'll multiply that by 360. So we get that it should be 32.5 days. And then we'll go ahead and do the same thing then for year two. And so again, you see for year two that the accounts receivable was 123,000. Then we'll divide that by the net sales of 1,095,000, multiplied by 365. Should be 41. So we see then that in the second year that it took us a little bit longer in order to get paid.